Um, yeah, welcome to today's webinar on corporate carbon footprinting. Um, my name is David, and together with my colleague Jacob, we aim to guide you through the topic of CCF, explaining the details on why we need CCF, what methods there are to execute one, and what practical aspects are there to note. We both have been with Kiva Sustainability for about 2.5 years and mainly have been working on the quantification of greenhouse gases on a product, but also on an organizational level. If you don't know Kiva, Kiva is a globally operating tech company, meaning traditionally we do everything regarding testing, inspection, and certification. Overall, we have over 12,000 employees, 200 locations, which are spread over 50 countries. We have, as Kiva Sustainability, are kind of a startup nested in this huge international network. We count 20 people, and we are seated in Berlin. And yeah, with over 10 years of experience with all things sustainability, we can help with basically every sustainability need that you might have. In terms of CCF, we are accredited to create and verify CCFs according to ISO 1464 and ISO 1468. And while our direct team is seated in Germany, we also have a lot of colleagues abroad, which have been trained in sustainability matters. So every Kiva service basically has someone in a lot of the big countries that we service, which can help you directly. And all of the CCF work we do in our Rethink software, which we will also present later. But now let's get to the nitty-gritty. In this session, we will walk you through corporate carbon footprint, why it is relevant on a big scale, and of course, why you should have one. This we will follow up with the relevant regulatory framework, ranging from regulations as a driver for CCF on the one hand, and of course, regulation on how the CCF creation itself is regulated. We will then move on to practical aspects such as boundary setting, data collection, calculation approaches, and so on, so that you have a general idea on what you can expect when working on a CCF with us. This will be a truckload of information, and it might seem a bit overwhelming, which is why we try to keep it concise, while also giving you, of course, a lot of specifics. And then we will finish with a Q&A in which you can address all of your questions. If you have questions during the presentation, please write them in the chat, and whenever they pop into your head, and our colleague Julia will sort them, and in the end we will take care of all of that. The slide set, of course, will be sent to you afterwards as well. Okay, so introduction. Okay, there we go. Greenhouse gas reporting has, as you might know, become a key instrument for climate governance and corporate accountability. It enables you basically to quantify your climate impact, to identify where your emissions come from, and to develop targeted decarbonisation strategies to address those emissions once you know where they come from. And all of these actions, of course, are highly important, as you can see in these pictures, because industry in general and industry in Germany specifically is a very large contributor for the European greenhouse gas emissions, which is why we have to take action, basically. And because we have such a big impact on the environment, there are central regulatory drivers in the European Union that we need to talk about first. And this one central driver on a regulatory basis is the European Green Deal. It was first presented in 2019, and its general goal is basically to reduce the EU's net GHG emissions to zero until the year 2050. And under this deal, you can see a lot of big and smaller regulations, which are all very relevant tools to steer carbon emissions, but which are not all directly related to CCF. So today we will focus on the CSRD down here, which mandates companies of a specific size to report their CCF in a non-financial reporting. Through the recently accepted Omnibus initiative, the number of companies that actually have to adhere to the CSRD has decreased. But even if this regulation, so the CSRD, currently does not directly apply to you, it probably applies to one of your big clients, which means that they would need your data, which means that you need a CCF. And then we have the CSRS, which is, no, sorry. So we have the ESRS, which is the European Sustainability Reporting Standard. And this basically regulates how the CCF that is based in the CSRD has to be created. So, and in this ESRS, the only mandatory standard is the E1, which is climate change, as you can see here, meaning that in the scope of the ESRS and the CSRD, climate change, so the CCF, is the only actually mandatory standard. So yeah, it is highly important. So further benefits of conducting a CCF, because CCF is not only a compliance requirement, which we just talked about, but it can also be a strategic management tool. On the one hand, it can enhance the corporate reputation that you have, because we live in a society in which stakeholders focus on transparent, sustainable business practices. And transparency in this case means that they are quantifiable and verified data. So it's not just saying you have a green product on your website, but actually, being able to back that up. And this data, apart from transparency, also helps you, the company, to identify hotspots in your carbon emissions, which could then be used to change, for example, a supplier. And then you can reduce travel distance, or you could introduce other sustainable practices, like, for example, install PV modules on your roof, and that could, on the one hand, save costs in the long run, and also, increase your energy security in times of great uncertainty like now. That could be also a very important factor. And all of that can also foster innovation, of course, because when you identify a risk factor, you can come up with an innovative solution for it, which can lead to innovation. Through the increased incorporation of sustainability metrics in public tenders, a CCF can also become a requirement to access certain markets or companies. This is, for example, in Scandinavian countries, that is a big thing. Furthermore, it facilitates access to financial institutions that require robust ESG performance, and oftentimes you can receive more favorable terms with a risk reduction strategy that is based on environmental performance data. And last but not least, of course, social responsibility. We all live on this planet, and we should strive to do as much as we can to take care of it. Okay. And now that we have a basic understanding of the why we do it, let's talk about the what we do actually. In broad strokes, the corporate carbon footprint quantifies the GHG emissions of a company's operations. It is a snapshot of your company's current GHG emissions, and the results can be disclosed in your non-financial and sustainability reporting. As sustainability and non-financial reportings are supposed to enable comparison between companies, the way to create a CCF is standardized. And two standards come to mind here, which is the ISO 1464 and the Greenhouse Gas Protocol. The former is broader framework, which basically focuses on the organizational boundaries, quantification methods, and the reporting requirements, as well as the verification of the CCF, while the GHG protocol has more of a practical approach and gives basically detailed explanations on how to proceed with the calculations. And generally, the CCF is split into 3 scopes. Scope 1 details direct emissions that are immediately controlled by the company. So for example, if you have a car, a company car, or if your machines burn fuels, this would be a direct emission. Scope 2 is about electricity that you buy. So the actual emissions do not happen on site, but they happen, at your electricity provider, basically. And Scope 3 emissions, which are not mandatory to be reported, but are generally the ones with the highest impact and the lowest availability of data as well. They encompass your value chain up and down. So the emissions that happen during the production, for example, of raw materials, those would be in Scope 3. And Scope 3, there is a major difference between, or not a major difference, but a difference between the GHG protocol and the ISO standard, because in the GHG protocol you have Scope 3, and in the ISO standard Scope 3, while containing all the same data, it is split into 4 different categories. Also important to note is that CCF expresses various emissions as a single impact category. As you are aware, there are different greenhouse gases, not only carbon dioxide, but for example, also there's methane and there's nitrous oxide. All of these gases are expressed in kilogram of CO2 equivalent in a CCF, meaning, for example, nitrous oxide traps heat 298 times as efficient, so to say, than CO2, which means that 1 kilogram of nitrous oxide emitted equals 298 kilos of CO2. And through this single impact category, this kilogram of CO2 equivalent, we get increased comparability and ease of use for different stakeholders. And all of this is basically summarized here in this picture. You have the split emission, where are we here? You have the split emissions between Scope 1, Scope 2, and Scope 3, or categories 3 to 6. You have the Scope 2 emissions, which are indirect over here, and you have all of the different Scope 3 emissions, the indirect ones, here and here, down, upstream and downstream. And now I'm done, and I will give over to Jacob regarding the implementation and practical approach.
Thank you, David. So I would like to start by giving a brief overview over the corporate carbon footprint process and then explaining individual steps afterwards. And yeah, as you can see, the CCF process starts by defining the boundaries to assess which operations and entities of a company to include in the study. Afterwards, based on this boundary setting, the activity data is collected, emission factors are applied in the calculation part. So this is something that we do, but also where customers want to do calculations by themselves to have more control or insource the process. The results of the calculations are in both cases presented in a report where methodology and frameworks are described. And afterwards, based on the results and based on the calculation and the report, the verification is conducted. This is done by a third party. And afterwards, the results of the corporate carbon footprint can be used in mitigation strategy, net zero planning, and thereby achieving the net zero goals outlined in the Paris Climate Agreement. Next, please. So the boundary setting step consists of two parts, actually maybe three parts. So the first part would be to set the period of the corporate carbon footprint. This is usually 1 year, so either the fiscal year or the calendar year. And both organizational boundaries and operational boundaries are then assessed based on the reporting period. Organizational boundaries determine which entities, so which sites or subsidiaries to include in the corporate carbon footprint study. And then the operational boundaries define which emission sources to consider. Incorrect or unclear boundary settings can lead to inconsistencies, such as double counting or emissions, and therefore must be carefully defined. Next, please. To set the organizational boundaries, there are 3 consolidation approaches, which are the operational control approach, the financial control approach, and the equity share approach. The selection of the approach depends on the company structure, the reporting objectives, and the stakeholder expectations. And to explain them quickly, the operational control approach is when companies account for 100% of the emissions, where it introduces or implements operating policies in another company it owns or partly owns. Financial control is when a company accounts for 100% of emissions when it introduces or implements financial policies. And equity share approach, which is not allowed under the CSRD reporting, is when a company accounts according to the share of equity in operations. It is very important to apply the chosen approach consistently over time and to ensure comparability of results over several years. This slide, I would like to show how this plays out in practice. So the continuous line should show the entities that are included in the inventory of our example company. That could be due to having financial or operational control or owning 100% of the equity shares of those entities. Then we have the dashed lines, which is the subsidiary and external logistics. So these parts could, for example, show that the share of equity is not 100%, but both parts might be included in the inventory according to their equity share of, let's say, 51%. And the exclusion of production site 3 may be due to another company having operational or financial control over this production site, or the equity share being 0. Regarding scope 3 emissions, so other indirect emission sources, we conduct materiality analysis to assess which emission sources to include. And this is due to the complexity of those emissions. Scope 3 emissions occur in the downstream or upstream of a company's operations. And this analysis, the materiality analysis, typically considers several criteria, such as the share of total emissions, the degree of influence of the company over those emissions, stakeholder expectations, and the relevance for risk management. And based on the assessment, the relevant or material scope 3 emissions are selected for inclusion into the inventory of the company. Scope 3 has quite a higher relevance for companies, as in most sectors, scope 3 emissions account for the largest share of total emissions. So in this figure, you can see the share of scope 3 emissions in different sectors. And in my experience, especially for raw material production or manufacturing, scope 3 emissions account for about or even more than 90% of the total emissions. So assessing scope 3 emissions is of high relevance. Exceptions might be sectors such as energy and transportation, where direct emissions are quite dominant due to combustion of fuels. However, in those cases as well, scope 3 emissions are relevant and lead to a complete and accurate corporate carbon footprint. This leads us to the next step in corporate carbon footprinting, which is the activity data collection. The activity data is the foundation of the calculations of emissions. And in our calculations, we need both primary data and secondary data. Primary data being, for example, meter readings or invoices. So data with high accuracy and must-have for scope 1 and scope 2 emissions calculations. For scope 3 emission calculations, we often have to apply secondary data as well, so estimations if primary data is not available, and applying secondary data opens the door to calculating emissions that are difficult to assess. Next slide, please. So this table presents data collection for two scope 1 emission sources, which is direct emissions from stationary and mobile combustion. So stationary combustion is, for example, the combustion of fuels in boilers for heating or in turbines for operations. And usually fuels are natural gas, biogas, fuel oil. And the data sources for those emission sources might be meter readings or invoices or logs or different sources which include the number in kilograms, cubic meters, kilowatt hours of those fuel combusted. Another example is very important for manufacturers, for example. It's the upstream emissions of purchased goods and services. And this is so important because it often is the scope 3 emission source with the highest emissions within scope 3. So what we usually need from suppliers is their life cycle assessments, which is then a connection from the organizational level to the product level, as we purchase several products from several suppliers. The more complete their life cycle assessment portfolio is, the easier it is for us to then assess our own emissions, because we don't have to use secondary data as intensively. Now, another example is, for example, the scope 3.3 fuel and energy related activities, which relate to the up and downstream emissions of fuel and energy production. We report the direct emissions, so combustion of from the combustion of diesel in a car, for example, in scope 1, but the production and distribution of the diesel has to be accounted for in scope 3.3. And therefore, we use the same energy invoices or fuel reports we would also apply in scope 1, but apply a different emission factor, as we don't want to assess the direct emissions, but the upstream or downstream emissions. Next slide, please. So I just mentioned the emission factors. We now are in the calculation phase. And we multiply the activity data with the emission factor to convert the activity data into actual greenhouse gas emissions. In simple terms, emissions are calculated in all cases by just multiplying activity data with one corresponding emission factor. But we need, especially in scope 1 and scope 2, emission factors that cover emissions divided into several greenhouse gases. The emission factors come from reliable databases or research. Some databases that are quite common are, for example, the DEFRA database of the UK Environmental Agency. We also have the Environmental Agency of Germany providing such a database, and we need often the EcoInvent database or life cycle assessments or environmental product declarations of our suppliers to assess our Scope 3 emissions. Then, when the calculation is finished, we need to document our calculation and the methodologies we applied in a report. This report is then used in the verification to have a transparent tool for verifiers and auditors to assess if our calculation was done according to the standards we applied. We have one standard that outlines the requirements for such a greenhouse gas verification, which is ISO 14064-3. And this framework defines the activities, the processes, and ensures credible and accurate verification of corporate carbon footprints. The activities might include assessment of the data, of the calculations, of the report, whether the methodology was applied in correctly. And these activities are strictly separated from the consulting part. So we at Kiva, we have separated entities to do consulting and verification. We as Kiva have auditor network in different regions and industries to ensure quality in the verification process. And when this step of the corporate carbon footprint is concluded, the results of the corporate carbon footprint can be used in, for example, sustainability reporting, in communications with customers, with financial institutions, with the state, but also, last but not least, in continuously improving the company's carbon footprint by developing mitigation strategies and working towards the net zero goals. I want to quickly mention also our calculation tool. So in some cases, companies use, for example, Excel to do such corporate carbon footprint calculations. We use our in-house software Rethink. It is a software developed for carbon accounting according to ISO 14064-1 and the Greenhouse Gas Protocol, but also on product level for life cycle assessment, environmental product declarations, product carbon footprints. Rethink comes with several databases which are tailored to your needs. It has excellent interfaces for efficient calculations, and it prepares companies quite well for third-party verifications. Next slide, please. This concludes our webinar, and David and I want to thank you very, very much for your attention. And we are open for questions and would like to have a discussion with you about corporate carbon footprinting and all steps in the journey.
Thank you so much, David and Jakob, for your presentation. So I looked at the chat, but so far there are no questions. So dear audience, don't be shy. If you have any questions, just post them in the chat. For now, yeah, maybe I would throw in one question as a start.
Yes.
And then maybe others will follow. So, Jakob, to you, what are particular challenges that you usually experience with your clients when they are compiling a CCF? Maybe also what are typical mistakes they do, so that our audience knows what to watch out for.
Yeah, thank you. So one challenge for sure is the data collection. This the step that has the highest requirements in terms of time and resources, I would say. So maybe one mistake to avoid is the planning of too little time for especially this part, but also other parts of the corporate carbon footprint. Yeah, the data collection, one common challenge, I would say, is that there's almost in all cases some data available based on the activity, but also some data only available based on spending. So this then sets different requirements towards the databases or emission factors to choose, and sets different requirements regarding the documentation of data. And this is something to keep in mind while preparing the inventory, but also while preparing the report, for example. And yeah, but it is also a great opportunity for learning, improving the inventory. So it might be activity-based in the future for all products purchased. And yeah,
Thank you, Jakob. So there are still no questions in the chat. So maybe everybody, is satisfied with their information they received. And so I would say maybe we can also end early if there are no other questions or no more comments from your side.
No, I don't have any comments, but I would like to thank you all for joining this webinar, and have a nice afternoon.
Yes, same.
Thank you so much for the presentation.
You're welcome.
Bye-bye.